Good afternoon, everybody, from across the lands. This is Steve Van Houten. I'm President, Chairman of Lifetime Financial Advisors, and today we're doing a mid-year update, which is very appropriate to just maybe a little volatility out there. So hope everybody's having a great summer, and this is our 7th webinar of education for our clients and the community that we serve. So thank you for joining us today. I'm going to kick this over to David, who will take us from there. But thanks, everyone. We'll see you later.
All right. Thanks, Steve. Thinking about this call today, times like these are a good reminder to revisit your personal financial plan, investment strategy, and cash flow. So thinking about both history and our collective experience at Lifetime tells us that disciplined investors do far better, have better outcomes by not reacting emotionally, instead of having a strategy to navigate different markets and economies. So as we navigate these times together, we want to look at potential planning opportunities that we can do, whether that's some rebalancing strategies, Roth conversions, tax loss harvesting. That's something we can talk about. You can talk about with your advisor here at Lifetime. And just to reiterate, we appreciate your continued partnership. In the slides we just saw, we have our firm motto and philosophy, which is through a lifetime of commitment and partnership, we provide financial clarity, confidence, and understanding to our clients. That's really our mission and what we're trying to do, the purpose of this call today. So again, thank you all for being here. I'm going to go ahead and push this over to Luke to give us a few notes before we dive in.
Awesome. Well, thank you, David, and thanks to everyone for joining us. It's really cool to reflect. This is a full year of LFA Presents, bringing some timely value add, whether it's financial markets, financial planning, strategies, and techniques to our clients from some of our fantastic partners, both from asset management and beyond. So today we're really pleased to have Damian Eckstein from American Funds. As many of you are familiar, American Funds, also known as Capital Group, is one of the largest asset managers in the world. They were founded back in 1931 and manage over $2.6 trillion, excuse me. Hopefully it's not a billion now with some market volatility. But to have the opportunity to bring the weight of a firm like American Funds, the resources, the practice management, certainly the investment expertise, and knowing what's going on in the markets with their global team is tremendously valuable for us internally. And to share that with you all is an awesome treat. So Damian, we're really privileged to be able to be in partnership with you, not only on this initiative, but across our investment portfolios, from small startup Roth IRAs all the way through retirement plans, 401ks, and taxable and retirement assets for our individual clients as well. Damian has been in the industry for 25 years. So you get the Silver Anniversary Award here coming up, I think in August, if I'm not mistaken. Starting his career at Franklin Templeton, and it's been covering advisors across Orange County and now San Diego. So really pleased to have you with us this afternoon, and for being a great sport. Damian's overcoming the tail end of COVID, as I'm sure he'll get into, but you look great on camera, and really appreciate your time and bringing the weight of such an awesome firm in American Funds to our clients. So Damian, we'll turn it over to you. Before I do though, as far as just Q&A towards the end, housekeeping, as we've done in the past, we'll let Damian continue through the bulk of his presentation. And at the end, go ahead and raise your hand through Zoom. There's a little raise hand icon at the bottom of the screen. Click that button, we can unmute your line, and we can keep it a very interactive Q&A session. So thanks again for everybody's attendance and partnership. Damian, I'll turn the call over to you.
Luke, thank you so much. Let me start by sharing my screen here. I really appreciate the opportunity to be here, and I'd be remiss if I didn't start by saying thank you. Thank you to Lifetime Financial for the continued partnership with American Funds, and certainly taking your clients' best interests at heart. And then for all those of you on the line listening, we appreciate the trust. Many of you own some of the American Funds, and it's the only business we have, which is managing client assets. So we truly, truly appreciate the trust you've shown over the years, especially at a moment like this, where it's been a little bit more difficult to have the intestinal fortitude to stay the course. So again, truly appreciate it. Before we went live, we were talking a little bit about, in some cases, 4 generations of clients working with LFA, right? 4 generations of investors. That really is a long-term time perspective. And I always caveat these beginning of the year or mid-year outlook updates with the following. We think about investing the same way I know the LFA group talks to you about investing, which is long-term. So I'm going to make some short-term comments about what we're seeing, but the lens with which we look in making investment decisions are really on the long-term basis. Now, that's is not just talk at American Funds and Capital Group. Luke was nice enough to say we're one of the largest managers, certainly one of the largest active managers out there. And we've incentivized our investment folks based on their 1, 3, 5, and 8-year results, and 75% of their compensation. So 3/4 of their comp is based on their 5 and 8-year results. Now, why does that matter? Most firms pay based on 1-year results, right? Like, what have you done for us lately? But they ask you as an investor to think long term. We've aligned our thinking about investments with the way you should think about investing as an investor. 5, 10 plus year time horizon. So when I heard Luke and Steve and David talk about this idea of many 3rd and 4th generation families at LFA, it really made my my heart warm and my smile large, because it fits in line with the way we view the world. And I think it's important I say that, because right here on the front cover of our mid-year outlook, it says long-term perspective on markets and economies. Now, what I'm going to do today in full is really touch on 3 things. First, I want to talk about the macro issues that we're seeing. So the big picture economic view of the world from Capital Group and the American funds. And then we're going to dive 1 layer deeper, talk a little bit about what we're seeing from the equity markets, or think about stocks, and then a couple slides about what we're seeing from a bond market and the opportunities there. Now, I have the easy job. My job is to simply talk big picture. The folks at LFA have a much more difficult job, which is to make sure that you're in the right portfolio for your risk tolerance, right? Your long-term goal. There's an objective-based portfolio built that meets that goal over time. So I'm going to be talking big picture. It doesn't necessarily mean that anything I say should be represented in your portfolio right now, but it's just a framework with which to think about. Now, on the screen, you see Rob Lovelace and this idea of an all-weather investing. Earlier this year in our 2022 Outlook, Rob talked about having an umbrella and a raincoat near, that he saw some clouds forming, and the possibility that it was going to be a bit more difficult as an investor than it had been the prior number of years. In this note, he said he was glad he had it there near him, that raincoat and umbrella, but it probably happened a bit sooner than we thought. So it's gotten a little bit more difficult. We've gone through a period, outside of that couple months in 2020, we've had an uninterrupted bull market. There's been a quarter here or there, but we've really done nothing but go up since the 09 bottom. So, tough time in 07, end of 07, all of 08, first quarter of 09. But really the last 12 years or so, we've had a robust stock market. And now where do we sit today? So if we think about the macroeconomic moment, where do we sit in a business cycle perspective? We're solidly in late stage of the economic cycle. So what do you see in late stage economic cycle? Labor markets are tight. And I think we could put a check there, right? You can't turn on the news without hearing about how we're late, how we have tight labor market. It's hard to find employees. And if you've been anywhere recently, I was the guys mentioned, I have COVID right now, or I'm at the tail end of it. I just got back from a vacation in Hawaii. There were more people there than I've ever seen, and not enough workers to do any of the work. So it's created some issues there with tight labor markets. Costs are soaring. So some of this is the broken down supply chains from COVID. You still have lockdowns in China. It's caused an imbalance between what people are demanding and the actual supply that's available. But costs are starting to soar. Profit margins are contracting. Right. Again, another check. We're starting to hear companies talk about how it's tougher to make a profit because costs are going up, and they're not able to push all of that onto us as consumers because we're getting tapped out a bit. And then finally, in part of a normal late cycle moment, you'd see central bank policy tightens. Now, that's an absolute certainty, right? We were living large on this idea of the U.S. government and central banks everywhere giving us free money, i.e., that we're not allowed you didn't have to pay a high interest rate if you wanted to take out a loan for a bank, for a car or a home or an electric bicycle or you name it. You're starting to see that move higher over the last number of months, and we think that will continue. So if you look here at these bubbles, you'll see most of the major world economies solidly in late cycle from an economic perspective. It doesn't necessarily mean a recession is pending imminently, but we do, if you talk to our economists, believe that the chances, the percentile chances of a recession coming soon, when I say soon, the next, let's call it 12 to 24 months, is growing. Because if you say, is there going to be a recession? The answer is always yes, right? Like whenever you have a booming cycle, what's inevitably going to happen sometime in the future is a recession. The question really is that recession imminent? And when I talk about that, it's, the next 12 to 24 months. And we'll talk more about that and what could come in the slides as we go forward. We have a group called the Night Watch, and if you're familiar with the 17th century painting by Rembrandt of the same name, it was this idea that people are looking everywhere. So it's a group of our portfolio managers, our analysts, our economists that get together. They have various points of view, and what they're really trying to do is look at all the possible scenarios that could occur and add probability to each of those occurrences happening. And then what possibly you might see in the market. Again, we don't have a crystal ball. And this is some short-term thinking, but what we're trying to do is determine what are the potential pitfalls and what are the potential, moments of pride and catching a great market. And the reality is no one knows. And Luke said something in the intro to this, which is, our clients have stayed the course. I think David said it. That's really the key because no one knows. But what we look out here as the biggest possible scenarios today, if you went from left to right, it's the de-escalation to the escalation of the Ukraine-Russia war. That was, or that has been something that's really driven inflation higher. It's driven a lot of the issues that we see today. It sped them up from our perspective. On the other axis, we look at this idea of global monetary and fiscal tightening versus additional stimulus. Now, if you look to the upper right, this idea of a global recession, inflation is untenable, recession ensues with Europe deeply affected. So if you had this really deep recession, what might be the possible outcome? We think in that world, cyclical stocks could fall 30 to 40%, materials, industrials, financials, and travel would be hurt. Again, just one potential scenario that we look at. The opposite is a peace relief rally. So imagine that inflation isn't as bad and starts to come down. And I turn on the TV, or we turn on the TV, whether it's CNN or MSNBC or Fox or whatever your flavor is, you see Putin and Zelensky shaking hands, right? Like it seems like an impossible moment right now, but maybe it happens. In that environment, cyclical stocks could gain 15 to 20%. Materials, industrials, travel, from our perspective, all would benefit. So we're trying as an investment group to look at all of those possible potential outcomes and assign probability to what is most plausible, and based on that, where we want to be as an investor, not for tomorrow, but as we look at over what that will mean 3 years from now, 5 years from now, 8 years from now. Now, what we know for sure is you should expect a little bit more volatility as the Fed fights inflation. What you're looking at in this graph, and let me grab my pen here. I tried to circle the graph here. That was really a bad circle, but it's hard when you're not using your hand and you're using a mouse. But when you look at this here, this graph shows where Fed funds rates are targeted. So you hear a lot about this idea of interest rate. The Fed funds rate, and I might be simplifying it a bit too much for some, but just so we can level set, the Fed funds rate is the amount the Federal Reserve charges member banks to lend, right? So everything is based off of that. And the grayish areas are periods that we've seen recession. And what we know for sure is that if you look over the last few rate hiking cycles, it's been about 38 months from the first rate hike to a recession. Now, there's a little bit, we think it's a little bit different this time. And the reason we think it's a little bit different is for the first time in 40 years, we're fighting inflation. And in prior cycles, the second the economy starts to sputter a little bit, the Fed has had the ability to reverse course and lower rates again, add stimulus to the system, and stabilize the market. We think this could be a little bit more bumpy, and we just want to be honest about that because we don't think the Fed will be able to reduce their rate hike cycles as fast if we get a quick recession off of this, because they're still going to have to fight inflation. Now, the nice part from our perspective is, and we'll talk about this a little bit later, we think a lot of the damage from a fixed income perspective is priced into the market, and I'll show that more in a moment. But we do expect that you're going to see rates continue to go up. Rates, if you look at this graph, it's hard to see, but we're currently right here. What you see in this continued lighter blue move is what is priced in to the market, because it is now what is expected based on what Fed Chairman Powell said in his last meeting. So we're roughly in a range of 1.50 to 1.5 to 1.75% on the Fed funds rate right now. And the Fed has told us to expect to be around 3.5 by year end, and early 2023 to be in that 4 range to normalize interest rates. So the market knows that, it's priced it in, and we think we move off of based off of that. Now, after big declines, to my last point, you tend to have a pretty good bond market. So this bottom graph, I think, is really important because what it shows, this light blue move, so if I just drew this line right here, that's where we were 6 months ago in the 10-year. So we were about 1.2%. Where that ends is where we were June 15th, which was about 3.25. And the little green is where the market anticipates us being a year from now, middle of 2023. Now, why is it important? To my point earlier, most of the moves already happened. You'll see a lot more blue than green. So the market has already moved yields to essentially where the Fed believes, or the market anticipates us being a year from now. So that goes back to my point earlier that we think the most of the pain is done. And here's what we've seen in past cycles. So these are the last handful of Fed rate hike cycles. So January 77 to June of 81, April of 83 to July of 84, and so forth. The first number you see here, rising rate period, is how much they went up or down during the rate cycle. So you see some volatility, some down periods, some up periods. But what you notice is the 12 months following the rate hike, the bond market as a whole, measured by the US aggregate, so this sort of core bond index, has averaged about 13% for a 12-month period following. And in the second year, has averaged another 12.5. So generally, the point here is after these big moves like we've seen, and this is the worst we've ever seen in a move in the ag, you've generally had pretty good bond market returns. Now, again, my job is easy. I could talk big picture. Bonds may or may not make sense in your portfolio, but we've been at this really tough market where not only stocks were going down, bonds were going down. We now think you're in a more normalized market where if stocks continue to go down, you get the normal reaction of bonds, which would be to be more of a ballast to your portfolio. We haven't seen that yet, which has made this downturn a little bit more difficult. But we do think that as you move forward, you're going to have a more normalized bond market. And then the last point I want to make from a macroeconomic perspective. So we talked about this idea of being late cycle. There's certainly inflation. There's recessionary pressures. We're seeing rates move higher. But what we've seen historically is equity returns are pretty good during rising interest rate environments. So I don't want to suggest that we couldn't be near the market bottom, right? And there might be a little bit more pain beforehand. I don't have a crystal ball. But what I do feel most comfortable with is if we take a longer term time horizon, if we look out 3 or 5 or 10 years from today, investors will be well served to do the following. First would be stay the course if you're on the right course. And if you're working with LFA, I'm sure you're on the right course for your needs. So stay the course at minimum. If there's more money on the sideline that you've hemmed and hawed and you go, is now the right time? Maybe taking an approach of adding incrementally to your portfolio at this point, which means, hey, it could go down a little bit further, but you're getting a good price today. And maybe you got a little bit better price a couple months from now, but you're staging in to make additions into your portfolio makes a lot of sense from our long-term perspective. So we talked a little bit about this macroeconomic, the big picture that people talk about. And honestly, if you turn on the boob tube, that's what they're talking about, right? They're talking about this idea of the big picture. Now let's drive into opportunities. And the reason I say that is even in a tough market, there are opportunities to make money. Now, one of those from our perspective is rising dividends. And I love the following statement: rising income defeats rising prices. I'll say it again: rising income defeats rising prices. I know prices are going higher. I don't have to wait till the government tells me that inflation's 9%. I go to the grocery store. I like to do the food shopping in our house, at the Eckstein house. There's 5 of us, my wife, myself, and 3 children. One of them being a 13-year-old boy who can eat me out of house and home. And when I go to the food store, I know prices are up. When I go to the pump, I know prices are up. When I get any bill at home, I know prices are up. How do I counterbalance that? I can raise my income. And here's a perfect example. In the last 12 months, global dividend payments rose 20%, an additional $1.9 trillion in dividends. Now, dividends used to be the creme de la creme of investing. And the last 10 years, you've been in a market where anything but dividends, very reminiscent of the late 90s, has worked. We think that dividends are going to play a more important role in portfolio construction in the next 10 years than they did the last 10. And if you look over here on the right, I know the graph on the left is hard to understand. The graph on the right is easy to understand. And it's simply, there's a lot of yield out there. Materials, if you look at the all country world, so you look at the entire marketplace, the average material company is paying almost 4% in dividend today and growing. And even if you went to technology, which tends to not be dividend centric, you still got north of 1%. So there's a lot of dividend out there. And we think the market's going to reward dividends as we go forward. So an opportunity in the midst of a difficult moment. Generally, when you see moments like this, you get a change of leadership. Maybe this change of leadership from just owning technology to a more diversified portfolio that includes rising dividends makes sense. Now, I say that, and I also want to be cognizant that this is different than the late 90s. In the late 90s, it was tech, and those tech companies couldn't justify their prices. Today, I don't want to suggest that all tech companies are well priced. There are some that were overpriced and they've learned their lesson. There's some that are still overpriced. But there are a lot of companies that have good solid earnings. Those earnings are going to grow. And the opportunity in the cloud, whether it's, here we show Alphabet, Amazon, and Microsoft, with annualized growth rates that are almost 50, 35, and 25% respectively, there's still outstanding growth available in the marketplace. So I don't want to suggest that you don't want to have growth. I just think this is a moment, going back to that first slide with Rob Lovelace, that you want to think about an all-weather portfolio that includes good quality dividends or more value-based stocks and some of the quality technology names that are out there. So there are still great opportunities as we get through this bumpy market to make really outstanding returns in portfolios over the next handful of years. And then one last point that I want to make, and I'll do that over two different industries. Old, stodgy companies are actually important in the process as well. So what we're looking here is at the idea of mining companies relative to Facebook, and you know, a whole bunch of mining companies that have 50, 100-year histories, and then there's Facebook that's been around for a handful of years, and Facebook is almost as valuable. But if you think about these mining companies and the need in the cloud computing or electric vehicle, which will be a huge growth industry, there's a lot of old consumer companies that make product or pull things out of the ground that are really necessary in this move, in this technological advancement. And we don't think the market has fully realized those valuations. And it gives us an opportunity to buy companies in our portfolios in the midst of a global, dislocation for you as investors at really cheap prices. Another area to look at from our perspective is healthcare. Healthcare stocks trade, and this graph just shows relative valuation of healthcare sector to the overall market. And when we're in periods of red up here, healthcare stocks are expensive relative to the broader market. They were really cheap at the beginning of the year, a little less cheap, but still cheap from a historic perspective. So again, I'm at home with COVID. COVID certainly was a moneymaker for some of the drug companies, and will continue to be as people get more shots, and some of the companies come with therapeutics that are being used in the marketplace. But then also the demographics of the United States. So as we've all aged, we need more healthcare. The older I get, I know a couple things for sure. I have less hair. I know that for certain. And I know that more because y'all saw a picture of me in that intro on my bio that was taken a decade ago. And the first thing I thought of was, man, I had more hair there, and I didn't have that much then. And then the second is that I hurt when I wake up more than I ever did. And the driver of that is just as I age, I need more pills. I need more work at the doctor, and we're seeing that from a larger perspective across the board, and an opportunity that we see. Last thing I want to talk about, so we talked a little bit about macro, some areas we see equity opportunities. Now let me turn for a moment to fixed income, and I will tell you this: if all of the investment professionals at Capital Group, and there's roughly 450 to 500 people doing work daily, research daily on your behalf at the Capital Group from a global perspective, if I got them all together on this Zoom and I asked them, the fixed income people over here, the equity people over here, and I said, are you really excited about the opportunity you see? And I think the equity people, you would get the feeling that they're mindful of the risk, and they're trying to be measured. And the fixed income people would be pounding the table. And they'd be pounding the table because of this. If you went back 6 months ago and you simply looked and said, what do I get from a 2-year treasury? You got about 10 basis points. 0.1% was your yield. So basically nothing. Today you get, or in the middle of June, you got 3.2%. You added 300 basis points, or 3% more income on a 2-year treasury over 6 months. A 10-year treasury went up almost 3%. Investment grade corporates north of 3%. High yield bonds almost 5% more income today than you got 6 months ago. Now, what does that lead to? And I think it moves in tandem to a slide I showed earlier. based on the current yield of the US aggregate, so the bond market index, core bond market index, investment grade aggregate of 481, high yield corporate aggregate of almost 8.5%, emerging market debt paying almost 8%. If you look at that as a starting point and said, historically at this yield, what has been your 5-year return? In core bonds, it's been a little north of 4%, which isn't bad. Investment grade corporate, about the same. High yield bonds have, from this starting point, you've seen maybe 8% average annual for 5 years, and emerging market debt, and not for the fleet apart. And again, I got the easy job. Emerging market bonds, real big opportunity based on where we sit today. The 5-year norm would be about a 10% average annual when you have prices like this. But remember, you have to have the right intestinal fortitude, and that's why the team at LFA has a harder job, because that space is down 20% year to date. But as you could see, because of the increased yield, there's increased opportunity. And our portfolios that we manage have more fixed income today than they had 6 months ago, because the opportunity set is there and wasn't. Last thing I want to mention from an opportunity standpoint is municipal bonds. I know we all have our own thoughts about our great state we live in, and as Steve introduced, there's people here from more than just the the state of California, but U.S. states are in really good fiscal shape right now. Because we've all done well, we've paid higher taxes than we've had, and many states, including California, have record surplus. So what does that mean? They've had less reason to go out to the debt market and ask for money. So there's been less issuance of new municipal bonds. And at the same time, the tax burden on you, me, and our fellow Americans has been greater. So when you have greater tax demand, and probably even growing because we've spent so much money, and less supply of these bonds, generally what you would think is it'd be a good time to own those individual municipal bonds. Now, in the near term, that hasn't been the case, because as interest rates have moved up, municipal bonds are one of the most interest rate sensitive bonds out there. So they're more sensitive to changes by the Fed. That's what we just went through. So muni bonds have had a lot of downside, which isn't normal for municipal bond buyers. Because of that, people I know got scared, they got out, and created even more downside, right? Because they're just getting out, which means they're selling and prices are coming down. So with that, we see a real opportunity for the right investor. Again, my job is easy. I get to talk big picture. But municipal bonds, again, are offering some really attractive yields relative to what we think you might be able to get in the marketplace, certainly 6 months ago or 12 months ago, or what you might see in the future. So what did we talk about today? I know we're getting right up to the time that the team asked me to close my comments and open it up to some Q&A. We talked a little bit about the macroeconomic, and I think what I would want to remember if I were you on that is it's been a bumpy ride here recently. Inflation is something that is a bit tougher to deal with, and because of that, we've had to raise interest rates. But this isn't the first time we've went through it. The market is able to handle these type of gyrations. And right now, at this moment, we think there's opportunity. In the stock side, it might be a shift to a little bit more dividends. It might be owning the right mix of tech names. You were in a market where you could own all of them and they all went up sort of indiscriminately. We think it's going to be a little bit different as we go forward, but still opportunity, especially if you're willing to lengthen your time frame and not think about 5 days or 5 months, but 5 years or 10 years. Certainly opportunity. And I would tell you, our investment professionals get more excited by a moment like this on the stock side than they do when everything is going up, because they're starting to go, wait, well, what do I have to be nervous about? And then from a bond side, it's been the toughest bond market of my lifetime and all of your lifetime, because it's the worst one that since the 1842, based on a recent Barron's article. But we do think the pain is behind you, and actually represents, for the first time in a while, an opportunity to buy fixed income, both taxable and tax-free, in your portfolios at relatively attractive incomes and valuations. So I'm not sure, Luke, am I passing it back to you for the Q&A section? I believe I am.
That's
Again,
perfect, Damian.
I want to end where I started, say thank you to the group at LFA for the continued partnership and doing what we know is the right thing over long periods of time for 4 generations. And then thank to each of you on the call for the trust you show in the American funds. We truly appreciate that trust and that ability to be long-standing investors with us alongside of us to see better and brighter markets ahead. So I'll pass it back to you, Luke.
Great, Damian. Well, hey, that's a lot of slides, a lot of visuals, and talk about great job keeping everybody engaged. I certainly found myself taking notes and just very engaged with the content. So thank you for being a consummate professional and having a great presentation aura about you. And while we're doing that, just to kind of recap a couple things that continue to come up in conversations. Damian, looking at a diversified portfolio, 60% stocks, 40% bonds, which has historically provided really, durable returns in all weather market conditions. It was the second worst period in history since the start of the year for that traditional 60-40 portfolio. And if the trend continues and we're just flat between now and the end of the year, and if today was December 31st, it would be the worst return in a 60-40 because stocks and bonds are both negative. So yeah, interesting what you pointed out towards the end of the call. Entering into this year, Tina, there is no alternative, was really kind of a battle cry in the investment landscape because bonds were really painful to own, knowing that interest rates were going to rise. And they didn't provide much diversification at all entering into this year. But one consolation is now that interest rates have edged up, the shock absorption that bonds can offer a diversified portfolio is dramatically improved. So that's something that we're evaluating, looking at our stock to bond mix, knowing equities and stocks are going to provide stronger long-term results. But bonds are looking more attractive right now for portfolio durability getting into the end of the year. Yeah. So it doesn't look like we've had any questions coming up yet.
I'll say something. So Damian, your perspective is very, very valuable. And I think we talk about navigating, we talk about patience, we talk about perspective. As I enter my 40th year in this industry, starting in the early 80s when interest rates were 21%, when you can get a money market fund with your favorite mutual fund company and you can make 21% on your money. And that navigation, that perspective, and that peace of mind. So we as advisors, we fight that war with ourselves. And actually, how can we be better for our clients who we serve? So we want to be certain. We don't want to be doubtful. And again, we want to look at history doesn't repeat itself, but it certainly rhymes. Yep. We're in a very unusual time in this great country of ours. More divided than ever. There's an upset, there's an unease, there's a malaise just out there by definition. And of course, when you're talking about your money, you look at your statements, peace of mind. So we're not Pollyanna, we speak the truth. But again, as David suggested, there's a lot of things that can be done. So we ask ourselves, what do we know today? How can we take action? How can we be very disciplined, very systematic, and most important, non-emotional? We've all flown. You just got back from Hawaii. I want my airline captain to be very experienced, very disciplined, systematic, and very non-emotional. Because we've all had turbulence. It's disturbing. It's scary, especially if you're going to Australia. Got 18 hours of this. We don't recommend jumping out, nor do we recommend jumping out of a long-term plan if we're on the right course. And Luke and David, Brian, our team, we've worked so hard through this COVID season And how do we get better? How do we discipline ourselves so that we can be strong internally to be strong for you? So I just kind of felt moved to, get that perspective. I went through 9/11, oh my gosh, it's different this time. Well, it's pretty damn different when you had 9/11. That's pretty different. And these big menacing mountains that we look ahead of us, which are frightening, and how the heck are we going to get over that mountain? And again, in time, they become just a mere speed bump in the rearview mirror. And with your American funds, you've been around so long, we've got long-term perspective and literature. And we've all the world events that should cause you never, ever to come out of the house, never to invest, from the Cuban Missile Crisis to, oh my goodness, all the wars, all the conflict, when Russia defaulted on their currency years ago, when Mexico defaulted, all these huge disturbing things. And through it all, you're still there with, $2+ trillion under management. We've got 4 generations of clients that we've served for a very, very long time. So it's time, perspective, and it's slightly different, but we'll figure it out. You're smart, we're smart, and together we're better.
Those were great questions. I'm gonna start where you started with high yield. You're absolutely correct. If I was to look historically, you would normally see high yield bonds. And again, just to level set, because everybody might not know what we're talking about, those are bonds that are lower rated. So companies that are a little bit less, aren't as good fiscally as maybe an Apple. So lower rated, but they give you more yield, and that's why they're called high yield. They tend to crack first. The difference this time, Harold, from our perspective was because you had a robust economy and inflation is really what started this, right? Because as inflation kept going up, you eventually had the Fed come in and say, we have to raise rates. And we were in a period of time for the last 2+ years where the discount rate, right? Like if you were doing a 10-year discounted cash flow analysis on a stock valuation, money 10 years from now was viewed in the marketplace as good as money today, which you and I and everybody on this phone know is not true, but that's the way you were able to evaluate stocks in that environment. And as that ended, stocks had to reprice. Now, our folks would tell you, I showed you a graph, the second to last slide talked about at this moment, if you went forward, high yield historically has been a good investment. Now, I will caveat it with this. If you believe, and 90% of the investment group of capital thinks that you're going into a recession in the next 24 months, it's not an ideal time to own high yield because you would start to see some lack of some inability to refinance debt in the high yield world, which would cause rates to go up and prices to come down. So this would not, from a historical perspective, be a time to be backing up the truck to high yield. Again, that's our perspective. Other firms might have a different perspective to it. But in the bond world, we would say own higher quality. And if you're going to take risk from an equity-like risk, which many times high yield really has equity-like risk parameters, we would tell you to own the equity today, not the high yield debt, and the bonds you own should be higher quality because we do believe in a recession you'll have some cracks in the high yield world, which would it would be a different series of events. Like generally you see high yield issues and then the market comes down. This time you saw the market come off. We think the high yield has cracked a little bit, but the larger crack might occur secondary this time. So I hope that answered that. With respect to supply chain, that absolutely is what caught many flat-footed, right? Like the Fed said maybe 1 billion times, maybe more, this idea of inflation being transitory. because everyone thought this supply shock that we saw would be shorter lived than it's come to be in reality. Part of that is the place we make the most stuff, whatever that stuff is China, and they're really still in the thrust of COVID. You know, we mentioned I had COVID. I was on a trip to Hawaii. No one was wearing masks, and I came home with COVID, not shockingly. And others I know that have been on vacation have been the same way. In Europe and Asia, masks are everywhere. In Asia, you're still seeing, especially China, some lockdowns. That's creating the supply shock that continues. Our belief is that you're seeing some of it abate and that it will continue throughout 2023. We do think that when you get to the end of 23, you've got a more normalized view. Now, the Fed keeps talking about keeping rates going up until inflation comes down to 2%. It's weird that they're saying 2, but the 100-year norm of inflation is 3. That seems like a disconnect. We think that they don't want to spook the market and change the number, but we think if you start to see the Fed or inflation normalize around 3.5%, you'll see the Fed come off of this language that talks about 2%, because we don't think that's necessarily possible long term. But we do believe that a slower economy, which you're going to start to see and you're already starting to see a bit, and the fact that the worst part of COVID seems to be behind, at least the worst part from a lockdown perspective, will lead to less supply disruptions as we move forward in this, and it becomes less of a factor.
Damian, on behalf of Steve, David, our entire team at Lifetime, thank you for your time and for your partnership and really bringing the intellectual capital of American funds, such a tried and true asset manager. And just what you were saying earlier too about the way that your PMs, your portfolio managers are compensated is really very much aligned with the end user, the end investor, for long periods of disciplined, patient investing. That's who we are. That's who you are. So I think the alignment is fantastic.
Luke, do you have a question? I see a question highlighted there.
No, that was just a thank you from a Mr. Tim. So Mr. Tim, thank you for thanking us, but thank all of our clients as well for tuning in and for your partnership. Whether you've been a client for a short amount of time, or whether you're a second, third, or fourth generation client, we really do appreciate that long-standing relationship and really seek to navigate ourselves and our relationship investment-wise, financial planning-wise, through these turbulent times. And there's light at the end of the tunnel, and with history as our guide, patience will be rewarded. So on behalf of everybody tuning in, thank you so much. This will conclude our call. Have a great rest of the afternoon and a great rest of the week. We'll see you next time.
Thank you.
Thank you, guys. Appreciate it.